Joining me now is Paul Christopher. He's head of global investment strategy at Wells Fargo Investment Institute. Great to see you. Thanks for being here, Paul. The question for you is, I guess, two things, right? One is, why has that trend flipped? And two is, how long is it going to last?
Well, yeah, the second question, that's your $64,000 question, but let me tackle the first one first. It's not unusual during a rally to see the market pause for a time when they start to get evidence of conflicting, or let's call them cross currents. And right now you've got a clearly slowing economy. The labor report last week highlighted that. You've got some emphasis on the Fed, which you just talked about. Will they cut in September? Will they not? Are we done with tariffs? We may be done with maybe most of the reciprocal tariffs, but maybe not all of the sectoral tariffs. Those have yet to work their way through. But the overriding, I think, shining light for markets right now is this whole AI trend, which clearly in terms of CapEx, capital expenditures, has been stronger this year than we thought it would be, and looks like in 26 it will also be. And the important part is that it may start to slide over to other industries. So industrials, right, as you start to build out data centers, energy, and you could get utilities in there as well. And so we think that trend is still developing. But right now there's a pause amid some of this back and forth about rate cuts or not. How much will the economy slow? How much inflation will we see from the tariffs that are already in place? It's just an opportunity to pause. We think it's a good opportunity maybe to take a little bit of money off the table, not everything.
Why has inflation been so slow to materialize? I mean, the Trump White House, I can tell you, I'm there almost every day. The Trump White House really feels that the market prognosticators got it completely wrong in forecasting sort of doom and gloom back in April. And inflation is not nearly what some of those critics of the Trump administration have said it would be. Is it because companies are just willing to eat these costs in the short term while they wait to see where the tariffs shake out, where the Fed ends up, and all the rest of it? Or is it something else going on in this economy that we're not talking about?
Yeah, we are seeing some of the companies maybe pause on the tariffs as they wait to see how many more tariffs there are going to be, and they have to plan their strategy for 2026. But in fairness to the critics, really, you had the tariff announcement on April 2, and by April 8, 9, you had a pause for 3 months. So everything went on hold. Yeah, and then the other thing that happened in the middle part of the year is that services really started to weaken. You can see this in some of the survey numbers, with services coming down in the ISM survey and the employment numbers there in particular, which have been a real driver for employment, for jobs overall. They have now switched to contraction. So you see some contraction in prices or some softening in services prices, and the delay in the tariff prices is giving people the sense that, oh, well, tariffs aren't going to do anything. No, we think they're just going to be a little bit delayed in their arrival.
So let's go back to that Let's go back to that $64,000 question that we started with, which is, you see this rotation happening. How long do you think it's going to last? And for investors, how do you play that?
Yeah, so again, it depends on how quickly these cross currents resolve themselves. And I don't mean to be evasive, but look, I mean, we have to see how quickly inflation makes its way now into tariffs make their way into inflation in the coming months. We think it's probably a 3 to 4 month affair, maybe even into early 26 before we see inflation start to peak there. We also have to see how fast the economy is going to slow on its own. Consumers really are burdened now with a lot of credit card debt, income growth. As inflation goes up, it won't cover all of the purchases that consumers want to make. So we're thinking slow into early 2026, and then begin to see some acceleration going forward in the economy. So for right now, all right, to get finally to the question, we think you want to stay overweight large caps here, and you want to stay overweight tech. But let's trim some of that tech. So, for example, we're overweight in information technology, but we just took the communication services sector back to neutral. We think that's a very straightforward way. Take that sector back to market weight. That's a good way to take some money off the table here and not run too many risks while some of these uncertainties and cross currents work their way through.
Large caps and tech, some solid advice there. Paul Christopher, good takeaways from Wells Fargo. Really appreciate your time.